This report brought to you by the Richmond Club, where investors and high-growth companies meet.
Our first speaker is the CEO of Lonestar Resources, which has grown the resources by over 50% per year over the last 3 years. Yet, in spite of this phenomenal growth, the stock is trading at less than half of its book value. Ladies and gentlemen, please welcome Mr. Frank Bracken.
Lonestar is a pure play operator in the Eagle Ford Shale of South Texas. We've assembled 57,000 net acres, up from 1,000 7 years ago in the crude oil window of our play. Unlike a lot of the oil and gas that gets produced in North America today, we have unfettered access to pipelines that get us to refineries and actually export markets. We've been moving a lot of our oil overseas for a number of years now, which gets us superior pricing. We are the technical leader in the play. We have 100% of our focus in the Eagle Ford Shale. We're using very proprietary targeting and drilling techniques to drill some of the longest laterals in North America, and these are yielding differential results. The company's grown very rapidly. We've grown our proved reserves at a compounded rate of over 50%. We've done that in terms of all of our costs at a cost of $7.53 a barrel. We're selling our oil right now for about $65 by contrast. We've grown our proved PV10, or the discounted cash flow, the discounted net present value of those cash flows, by 27% compounded. That number is about twice our current stock price. And we've grown proved and probable reserves value at a rate of about 19%. That value is 3 times our current stock price. We've got a very focused program in 2019 and 2020. We've set both of those programs in place already. We're going to drill more wells in the areas that we've been very successful in, and at $55 and $2.75, which is our benchmark planning price deck, those wells are going to generate 55 to 70% internal rates of return, so highly acceptable rates. We've always been very disciplined hedgers. 85% of our crude oil is hedged this year. 64% of our natural gas is hedged this year. This gives us surety of cash flows and surety of returns in year one and protects the balance sheet. 2018 was a stellar year for the company. We grew production 72% and doubled the EBITDAX. Imagine how disappointed we are when we've got a stock price that hasn't moved an inch during that duration. Growth is projected to continue. We'll grow production about 25% compounded through 2020 with our existing plan. The team is a bunch of people who've done it before. John Pinkerton, before leaving, built Range Resources into a $10 billion company. This is my second oil and gas company to be a part of the management team of. First, we sold to Noble Affiliates for a big price. And we actually on our team have, as a VP of Geosciences, have Jana Payne, who literally discovered the Eagle Ford Shale about 10 years ago when she was at Petrohawk. So a seasoned group of people, not our first rodeo. Very consistent growth in all the metrics that people tend to look at for oil and gas companies. And much more important than these things, which are a little bit abstract, this is what we're really all about. We're growing net asset value on a per share basis every year, and we're doing so while pretty rapidly reducing our debt metrics, which we think will ultimately lead to a superior equity valuation. But this is what we wake up every day to do. We're growing value on a measurable basis per share. All the rest of it really doesn't matter. While we're delivering those big picture results on an annual basis, we're also doing the things that the analysts in the market tend to like. In 2018, in every quarter, we met or typically exceeded guidance, and as you can see, grew our results really rapidly. So we're hitting on all cylinders. We're not just doing the big picture stuff. We're minding the P's and Q's and doing the things that we think will ultimately garner a lot of respect in the marketplace. This is a pretty big swath of South Texas. There are millions of acres in this play, and we've built them really into three consolidated baskets that give us a lot of scale and efficiencies in what we do. We have really tried to build a better mousetrap. When prices collapsed in 2015, if you think about it, oil went from 100 to 25. So our revenue per unit dropped 75%. Our margins dropped 87.5%. So you really had to reinvent ourselves. We chose to, and frankly, at $100 oil, anybody could make money in this basin. I mean, and some really not very savvy people were. With prices where they are today, they're gone. So there's a lot less competition. But what we did is we really focused on technology, and we did actually an exclusive joint venture with Schlumberger, where we pooled 5 of their technologies into what we call a geoengineered completion. Schlumberger actually took risk in basically donating the costs of those services unless our wells got 10% better recoveries, at which point in time I'd literally just pay them for their services a year later. If in fact we were able to really drive results 20% or better, I actually paid them a bonus. So Schlumberger looked at our team, looked at how we were doing things, and chose us as their exclusive agent and deployer of technology in the Eagle Ford. And the results, it's been a win-win for both of us. We really do a lot of things to try to improve our results over our peers. We run logs that determine actually how much movable hydrocarbon is in the space and pick very, very narrow windows to orient very long laterals, which is getting us better results. We're using something called azimuthal gamma ray tool, which gives us a multi-planar look at where we are in the reservoir and helps us keep those wellbores in the optimal portion of the reservoir. We're doing what we call smart completions. They're engineered completions. We're actually running logs to the total depth of the well, and by moving around our perforations, we can actually improve the porosity of the rock we're going to contact dramatically. We're also using diverters, which allow us to break the higher stress, harder to break rock, therefore getting more bang for our buck with every dollar we spend. And we're using these things really effectively, and I'll show you some examples of where we're going into areas where the industry has really failed applying these technologies and delivering radically different results, which is really our core business. The other thing we've done is we've really continued to push the envelope of extended reach laterals. 12,000 feet is the norm for us now. We'll actually get ready to drill a couple. We're actually getting ready to drill a couple 13,000 foot laterals. But really the point is that we've acquired most of our acreage in configurations that allow us to do this. A lot of the land that was acquired in this play won't allow you to do it. And as a result, we're able to generate much higher returns than a lot of our competitors. But you can see the difference between a 5,000 foot lateral and as short as 6,700 feet, but as long as 12,000 feet. It really turns our acreage into something that I would call these pedestrian returns in my book. You may think they're great for other businesses, but in ours they're really uninspiring. But by being able to drill the longer laterals and get more lateral contacted at a lower variable cost, we're able to drive those returns to really tremendous and attractive levels. And these are all at $55 oil, a far cry from the price we're receiving today. So I'm going to walk you through where we're spending money, and I'm going to do it in a little bit of a truncated fashion today. I'm going to skip a slide in the interest of time. But what we really are in a lot of ways is we're gentrifiers. We go into areas where the industry, and a lot of times back in the heyday, have drilled some really poor wells. We go in and analyze the petrophysics of the rock, and we determine that it wasn't, it's kind of like my golf game. It wasn't the driver I was using, it was the operator. The rock is good. It's just that the industry players that developed these areas really did a bad job. And in doing so, what they've done is they've really reduced the property value, if you will. They've let the houses run down in the neighborhood, and it looks like a slum. The reality is it's a good zip code. And so we find these areas. We can buy up the acreage really, really cheaply, typically about $1,000 an acre. And the way I look at that is my costs to get the land are less than 2% of my cost to drill the well. So my upfront costs to get in business here are really low. And we come in here, gobble up acreage, build critical mass, and then drill with our technology and re-rate the asset and turn slums into boardwalk and park place in parlance of monopoly. And we've done it repeatedly. This is an area of southwest LaSalle County. Doubt very many of you know where it is, but the Mexican border would be about right here. We came in here and took a farm out from ConocoPhillips, big smart company, right? Drilled our first 2 wells back in 2015, prior to the formation of our geoengineer completion design, and drilled pretty mediocre wells. However, in adopting our current technology that I described for you before, we were able to improve these results by nearly 60%, and have really drilled the best-in-class wells in this entire area. We've got dozens of locations to drill out here, and so we'll be hard at it this year and next, drilling wells in this zip code and achieving really high rates of return. This is the other part of this play, up here to the north. Came in here, observed lots of operator error out here. We actually picked a different target within the 150-foot interval of the Eagle Ford, about 50 feet high, because we mapped it with our petrophysics as having higher oil saturation. Oil sells for 60 and gas sells for 250 or 15 on an energy equivalent basis. I want to find as much oil as I can. I'm going to make more money. So we picked that target, and we've had spectacular results. Our first 2 wells just completely rewrote the playbook out here in terms of recoveries per foot. They were 100% higher than the average offset, and our oil recoveries are 150% higher than the average offset. So these wells are paying out in 7 months, unbelievably profitable. We've just drilled these 2 wells in red. They're on stream, and they're actually superior to these results. So it's repeatable. The projected IRRs on these wells are 100%. So a core piece of what we're trying to do out here. And again, I acquired that acreage for pennies. Moving, just to show you, this isn't just a one-trick pony. This is about 150 miles away on the other side of San Antonio. We came out here and over time have put together almost 12,000 acres. There's a challenge here in that all these little blue wells are shallow Austin Chalk wells. They've depleted the Austin Chalk, and when we frack into this area, ordinarily you'd lose a lot of your energy into the Austin Chalk, which would make for bad Eagle Ford wells. Our diversion practices have allowed us to avoid doing that, and we're drilling the best wells in the play. You can see here that we've drilled upwards of a dozen wells here. They're progressively moving to best in class here, and the recurrent returns are quite attractive. One thing I would point out, and it's really pretty significant, is 2018 was a pretty expensive year to do business in the oil and gas in the Eagle Ford Shale. Wells cost us an average of $9 million. Because of the softness in energy services, we've been able to go out and renegotiate our services, particularly our pressure pumping, and we're going to drill that same well for $1 million or $1.5 million less this year. The really good news is prices are back where they were, and that just means we're making more money. So what I've really tried to do is show you a couple of areas where we've gone in after technical failures by other operators, re-rated the assets, and we've got about a dozen years worth of drilling out here just in these 2 areas alone. So the things that have made us successful in 2018 are going to be the same things that make us successful in 2019 and beyond. I'm going to wrap it up now and just leave you with one final message. We are growing per share value about 25% a year. We're going to keep doing it, and ultimately we have the faith that the markets will ultimately be efficient. reward us for this either in our stock price, or the industry may become the ultimate arbiter of value and see the company as an acquisition candidate. So that's the Lonestar story. Thanks for listening.
If you enjoyed this video, please let us know. You've been watching the Richmond Club Report. If you've just come across this channel, please feel free to like and subscribe. I'm sure you'll find a lot of interesting and lucrative investment and trading ideas around here. We'll see you again soon on the next video. Cheers, guys. Have an amazing and profitable day.